Hello and welcome to this XTB Market recap for the week. My name is Walid Koudmani and I am the XTB UK Market Analyst for the UK, Italian and Arabic market, and today we're going to be taking a look at what happened this week of relevance in the news and in markets, and how maybe a few things to look forward to in the next week. The main theme of this week has been tech stocks, and as of late it has been an overarching argument. This presentation is provided for general information and marketing purposes only, and please be aware that information and research based on historical data or performance does not guarantee future performance or results. Past performance is not necessarily indicative of future results, and any person acting on this information does so entirely at their own risk. So today we will be talking about a few arguments. Particularly, markets have been ignoring political tensions such as the China-US tensions. Credit card spending has been increasing as lockdown ends in several countries. Oil has seen a surge as fundamentals have improved. FX markets, the emerging market currencies have been gaining amid stronger sentiment, which has driven demand for the dollar lower. And the weekly calendar this week was focused on the US Consumer Confidence Index and the Chicago PMIs. From top news, we saw the end of lockdowns in some areas in Europe and the US, which has seen crowds gathering, and this has become a major test to see the potential of a second wave, which is what many people fear. China has tightened its grip on Hong Kong by introducing a new law. The US suggested sanctions, but the scale has been limited so far, and today, in fact, Trump will be speaking, and we will see what happens there. Tech stocks have been soaring. Facebook and Amazon have hit an all-time high, while an Oxford professor has said that there's only for him a 50% chance for vaccine to work, and markets have been ignoring that news as well. But if some of you might have in mind that markets were surging every time there was hope of vaccine, so we can see the sentiment skewed to perhaps focus on positive news and positive potential news rather than actual news that is negative, and actual data and macro data that is negative. Although this week we had a bank holiday on Monday in the UK and the US, so we've had a 4-day trading week. So we've seen a tech rally of stocks, tech stock rally. Is this a new reality or is this a bubble? And we'll analyze this. Some markets like the US 100 have nearly fully recovered from the pandemic, while others, for example Southern European markets, have actually remained at depressed levels. So we can see that the US 100 index, which is the Nasdaq tech index, has almost reached levels prior to the crash. If you notice, the other two indices also started at the same point, basically. But we can see that the Spanish index and the Italian one, which I will show later, are actually still remaining at this level, while the US small cap, which is the 2000, and the US 100 particularly have actually gained massively. And there are a few reasons for this, which I will go ahead and discuss, but tech indices like US 100 contain stocks that should fare better in this new reality of working from home, social distancing. Of course, a lot of companies that rely on physical goods or physical locations are struggling. Service sector, of course, is the major one. Industry, the travel industry, including airlines, have been struggling. But the US tech stocks in particular have been able to reorganize and reprioritize in a way to allow their employees to work from home and maintain operations. Some of them might be doing it even longer term. However, these stocks are traded at high multiples, or were traded at high multiples even before the crisis, but this has been exacerbated at the moment. Investors have been choosing and have to choose chase growth stocks, so longer term investments, or pick up value in a hope for recovery, which is what many people have been doing, and that has been kind of the cycle that's been driving these indices as well. Does this fragmented reality suggest trouble? That's what remains to be seen, because as we can see that they all started at the same time and different factors have led them to recover differently. Is this a new normal or a sign of trouble? You can see that the most requested stocks, assets at the moment are gold, ETFs, the Nasdaq, so the US 100, dollar index, even though that's falling. And what does that suggest? So year-to-date returns show extreme anomaly. Positive returns for extremely defensive, such as gold and long-term bonds, in extremely offensive growth stocks assets, like these ones. Concentration in the S&P 500 is higher than at the top of the dot-com bubble. This means that a smaller percentage of companies carry a larger weight of the total index. So we can see that this ratio fluctuates as time goes on, but it spiked in right before the dot-com bubble. And in the dot-com bubble around 2000, we saw that it was around 18% and 27% of the 10 largest companies and 5 largest companies. But at the moment, we can see this spike of the 5 largest companies in the S&P 500 carry 21% of the weight of the index, while the top 10 largest carried 28%. This can be further explained by looking at the top 10 stocks in the index, and I'm sure many of you can see the changes just by the names. So we can see that in 2000, which is 20 years ago only, Microsoft, General Electric, Cisco, Intel, ExxonMobil, Walmart, Oracle, IBM, Citigroup, many of these have physical locations or are based on physical things. For example, Exxon is oil. Here we can see that now the top 5 are Microsoft, Apple, Amazon, Alphabet, which is Google, and Facebook. So all tech stocks, top 5 that carry the weight. These are the largest 10 largest stocks in the S&P 500 at the top of the dot-com bubble and now. The median price to earning is still quite lower now, but the price to revenue is higher. These metrics are for the past 4 quarters. Will results deteriorate in the near term? And will the Fed policy be enough to justify such high valuation? Fed policy being unlimited spending, unlimited support of the markets. Here we can see the extreme growth momentum also fluctuates. A few times when the RSI spiked, we saw a crash directly after. This happened in February 1980. You can see spike in RSI, spike in the growth value, and then a huge drop. Again in December 1999, the dot-com bubble. July 2015, crash next month in August, the RSI. And now we are approaching a similar situation, although it remains to be seen because this is unprecedented, of course, with the lockdowns, where the RSI is spiking, the growth value is also increasing, and we'll see where we go moving forward. So to sum up what we've been talking about, historical relations suggest present valuation levels could be unsustainable because of the Fed pumping in money. However, now more than ever, before central banks are encouraging risk-taking. So they are giving loans or just with their policy announcements. There are many new retail investors. Another factor is that there are many new retail investors on the market, which could inflate prices even more for some time. And we could take an example of Bitcoin in 2017, when the huge increase in demand saw the spike of the price. Now trading and stock investing is a lot more accessible to the general population, and the general population is more informed regarding that. From a portfolio perspective, could a more diversified approach be justified? That depends, because if we take a look at what we just mentioned with the concentration of stocks and the weighting of the stocks, you can see that a smaller percentage of stocks have a larger weight in the index. So diversifying usually tends to dilute that, especially if most of the earnings come from a certain sector. Short-term investors, though, have been focused on growth indices, where there's a strong trend, which has seen the push. It's a cycle of investors focusing on them, pushing them higher, the Fed coming in, pushing them higher, but the actual data behind them is not there to sustain it. Rather than longer-term investors seeking healthier investments with a stable outlook that can actually give a longer-term return. Markets are ignoring many risks right now. It seems like for tech, one of the major risks is unexpected deterioration in earnings growth potential. For example, Biden winning in November the general election in the US, and tightening regulations on tech companies or on increasing taxes, where Biden tweeted that Amazon should start paying taxes. Actually, he mentioned it on CNBC. And famously, Amazon is the highest valuation company, and they did not pay federal taxes. So those kinds of things may affect the outlook that people have of these tech companies, as there seems to be no obstacle for them at the moment. The macro data has been ugly, but card spending is on the rise on the other hand. So macro data includes unemployment figures, PMIs, GDP, any sort of indication of how the economy is going from a macro level. If we take a look at that, the situation on the stocks does not work in parallel to that at the moment. We can see the Bank of America shows that excluding auto sales, so not including cars, would now be actually positive for the year. This is effect of eased lockdowns and stimulus checks being paid out in the second half of April, which are now trickling back into the economy, which, statistically speaking, the lower income population, if you give them a direct injection of cash, it will make its way back into the economy at a faster rate than you give the top percentage or the companies, because sometimes we've seen that it ends up going back into stock buybacks or other ways of not reinvesting into the community. But now we're seeing the delayed effect of the stimulus checks in the US and the eased lockdowns, where people are able to reopen and even take part in the economy. Part of this is demand. Part of this demand is one-off. So the delayed spending, as I said, in the one-off stimulus, for now, is one-off. This demand recovery looks encouraging, though, and the risks are actually mainly tied to the second wave of infections, because so many people are out, especially in the US, where we've seen some states opening even though their numbers were actually increasing, which is not the same approach that Europe took with the much more strict lockdown for a set amount of time and then only reopening in stages once they met certain criteria. The UK is like that as well. And COVID data, actually emerging markets are in trouble at the moment, because what we saw initially was, of course, the epicenter was in China, then it shifted to Europe, then the epicenter shifted to the US, and now the US has reached over 100,000 dead. But the epicenter is starting to shift into emerging market countries. We can see here, this has been one of the worst weeks so far, the worst week, and this one as well, because we've had consistently around 100,000 or over new cases a day, and even during the peaks in other regions, the peaks were less than that. The distribution is also changing. Brazil is starting to take a larger part. The US makes up 28% of the deaths, slightly less now, but we can see that all the countries are kind of stabilizing, with the emerging market currencies or countries expanding. The reasons markets do not react, though, to this is it is affecting poor emerging economies, while the situation in Europe has improved a lot. And the focus has now shifted on any side effects of the reopening rather than the actual pandemic itself, because we've seen that Europe and the US, particularly Europe, have passed the peak. So now, as different countries take different approaches, people are waiting to see how this plays out and if there are unintended consequences or effects to this sort of reopening procedure. In the FX market, emerging currencies have recovered or are starting to recover, and could this be the end of trouble? We've seen some major breakouts on emerging market pairs, so USD MXN and USD ZAR, which on the platform on XStation 5 you can find, them being USD Mexican Peso and South African Rand, broke lower from consolidations on the highs. So they were trading at very high levels for a significant amount of time, and they managed to break lower from those levels because of the decrease in demand for the dollar as markets improved, or moods improved in the markets. Chief reason is improvement in global risk sentiment, as I've said. From the long-term perspective, EM currencies are cheap and the US dollar is extremely overvalued. And we've seen that in the past months, where in the absence of any safe assets, people were flocking to the dollar. However, with the pandemic now affecting Latin America so much, could this be the end of trouble for the US dollar? Looking at the situation, especially Brazil seems to be so vulnerable right now because of the fact that they handled the pandemic in not an optimal way, and now they're actually paying the price for that because of the fact that there are so many cases and increase, and they're actually overtaking many countries as the top. Taking a look at major pairs, though, we see the dollar USD, USD dollar pound, and Euro USD, which is the most popular pair. They remain subdued despite buoyant sentiment, which is recovering. The GBP, though, so the pound, is depressed by the negative rates discussion occurring in the UK, while Euro is actually gaining thanks to the hopes of a EU-wide stimulus package announced earlier this week and last week by the ECB. And worth around 500 billion euros, with the possibility to extend that. When it comes to the oil markets, of course, fundamentals have been improving, but are the bulls overconfident? Over the past 2 weeks, we pointed out improving fundamentals, and the oil prices have risen sharply. From, of course, many of you know the negative prices we went into for WTI about a month ago. However, demand could return to normal only moderately after the initial phase of strong recovery. And for now, the trend remains bullish, but watch for resistances around $40 for oil, which is Brent, and $36, $37 for oil WTI. This is because after the initial spike in demand, where people start to go back and the essential services start to go back and the economies start to reopen, there is going to be a cutoff line where that's going to be the new normal for a little bit, depending on what each individual country decides. So if a lot of people still don't go to work and they work from home, perhaps that demand won't increase. Or if there is no sharp recovery in demand for flights and air travel and all of that kind of traveling, then demand could halt at a certain level, and we'll see where that stops. That's the presentation. I'll just go over the chart real quick, give you a quick look on where we are currently on the 29th. Euro USD is, after several days of trading higher, now it's still trading above the 111 mark. Gold and other precious metals are recovering, although platinum is pulling back slightly on the daily. Cable, again, after a drop, we're seeing a slight recovery with cable at 1.23. And the Italian index, as I mentioned, we can see that this is the peak, and we are still at depressed levels compared to especially the US 100 index, which is almost at the previous levels, an all-time high. So hopefully this video was useful, and good luck with your trading. Thank you very much.